Good afternoon, traders and investors. Will back here with another one, coming to you with a Tuesday market recap. Hope all of you had a very good day of trading today. And in today's price action, guys, well, what started off as a fairly normal day, the bank earnings were good, then quickly unraveled at 10 a.m. Eastern time when we got somewhat of an unexpected surprise. ASML earnings were actually leaked into the marketplace and they unraveled the markets thereafter. The semiconductor index after that came down about 5.5%, ASML tumbling on the day about 17% to the downside. So as earnings season continues, guys, I expect to have a lot more of these surprises. Maybe not earnings leaks, but you guys get the gist of what I'm trying to say, right? Earnings season, a very volatile event, and I would not be surprised if there are many opportunities that open up on the horizon after such big drops potentially happen. So in today's news, guys, we are going to cover a few things together. Number one, we're going to cover 3 earnings that I have prepared for you guys. Number one is, of course, going to be the ASML earnings, which were supposed to be tomorrow, but we'll do them today since they were leaked. Somebody at the investor relation management department of that company is going to get a spicy email tonight, I do believe. Now, we're also going to cover Bank of America earnings, which was one of the largest banks to be reporting today. And we'll also be covering another one, guys, which is going to be United Health, one of your largest health players in the game as well. So some fairly big earnings to cover today. Thereafter, we're going to go through our major technical analysis rundown of our major stock market indexes, see how we're doing after today's big decline. Thereafter, take a look at our big tech names and see after today's decline, are there currently some opportunities to be had in big tech? Or possibly should maybe we be waiting for more of these earnings to come out to get us some better deals? And after that, lastly, guys, we're going to take a look at my portfolio for a few of the trades made today and a few of the closing trades as well, and what I still have open for the remainder of the week. So a lot to cover today, guys. Let's jump right into the action. SPY down a healthy, right? 0.78%. QQQ down to 1.34%. And the morning was fine. Take a look at what happened at 10 a.m. when ASML earnings were leaked. The market just completely unraveled. And a lot of that is due to the semiconductor action. You'll see that best expressed on the heat map, guys. The rest of the market, very, very mixed, right? But where were the pain points? Definitely in the semiconductor trade, ASML carrying down the entire index. Big tech names, fairly mixed. No major big up days, no major big decline days on our big tech names. Roughly flat across the board. Apple, one of your outperformers. Consumer defensives, doing quite well. Banks performing fairly well after their earnings, especially after Bank of America earnings. The bottom half of the market, healthcare, taking a little bit of a dip here because UNH earnings as well were somewhat underwhelming. That stock down 8%. We'll cover it in just a few short minutes. Industrials down a little bit, and energy as well down significantly after the tensions in the Middle East are now not escalating since last week. So a lot of the move in oil, guys, over the past 2 weeks was off the back of escalating tensions. And when those tensions do not escalate any further, well, it stands to argue that the price of oil will not continuously climb any higher. Keep in mind as well, guys, fall is usually the weakest seasonal period all year for oil in general. So we have 2 battling factors right now: geopolitical tensions in the Middle East and weak seasonality for oil, and they will continuously kind of play off each other. But do not be surprised that oil is specifically weak during the fall season. It is usually always the case every single year. So moving on to the one-day relative, guys, you'll see that, paired gains across the markets, right? To the downside, of course, energy, technology, and healthcare, mostly due to the earnings in ASML and UNH. And to the upside, real estate, defensives, utilities, and financials, boosted by the bank earnings, but also boosted by the fact that the yields, especially the longer dated yields today, had a significant decline. And we were watching for that. We'll cover that as well when we go over the technical analysis portion of the video. So that being said, let us jump into our earnings right away. I'm going to try to get through these as quickly as possible so that way we can move into different parts of the video. So number one, of course, is going to be the big one. ASML having their earnings leaked today, the company ending down about 16.25%. So what exactly happened? Well, let's take a look at the numbers, guys. Well, the earnings for this quarter were quite good, 6.5% beat on the bottom line EPS, and a nice little beat on revenue here by about 3%. However, it was in the guidance, and guidance, guys, is going to be the word of this quarterly earnings cycle. If companies are increasing guidance, well, we can expect good things. But if companies come in with either in line or negative guidance, I'm pretty sure the same thing is going to happen as last earnings cycle. You remember it was all about guidance because we have a lot of headwinds in front of us, right? We know that the consumer is getting slightly weaker. We know the economy is getting slightly weaker. Unemployment is somewhat sketchy right now too, so it's all about future guidance and future profits for Wall Street. And if you miss on the guidance, guys, expect to see some significant declines similar to what we had last quarter as well, right? Companies were reporting very good earnings for the current quarter, but if the future guidance was poor or underwhelming, you would see these 10-15% declines, and expect that to be the case for this earnings as well. So one thing's for sure, guys, I am patiently waiting for all these earnings to come out, and I will only strike after these earnings come out. I'm not really going to be playing earnings before, because we know how volatile they can be, especially in this market environment. So let's dive into ASML numbers. Chip firm ASML shares plunged 15% after warning of weaker China sales in early release. So let's move on. ASML said it expects net sales for 2025 to come in between 30 billion euros and 35 billion euros, at the lower half of the range it had previously provided. So the previous range, guys, was about 33 to 38, and they revised it to the downside. And that's about an 8% revision to the downside. So not surprising to see the stock come down at least 8%, but then speculation added to it and everything. The stock went down double that amount. Moving on, net bookings for the September quarter were 2.6 billion euros, well below the 5.6 billion euro estimate. This is how much money in terms of future orders they have in the pipeline, and they slashed the quarterly estimate by half. That as well added to the declines, guys. Definitely not a very good number there, at least. Moving on further, while there continue to be strong developments and upside potential in AI, other market segments are taking longer to recover. It now appears the recovery is more gradual than previously expected, said the company CEO. A little bit of context, right? Last quarter, ASML said that the second half of 2024 and 2025 should be a resumption to normalcy for the company. And now we're getting a little bit of timid guidance. Maybe that return to normalization for the company is going to take a bit longer than expected, which is why there was some timidness in the stock today and why we see an outsized decline, right? All of that together, slower than anticipated recovery in terms of cyclical natures of the semiconductor industry. Thereafter, we have the miss on the order book, and then we also have the miss on revenue guidance. All of that combined, 16-17% to the downside. ASML said that the early publication of its results was due to a technical error, which saw it erroneously publish a report on a part of its website. Somebody's getting fired tonight, guys. I'm pretty sure, right? Unfortunate. China concerns. The firm is facing a tougher business outlook in China due to US and Dutch export restrictions on shipments to the country. Last month, the US government rolled out new export controls on critical technologies to China, including advanced chip-making tools. Separately, the Dutch government announced plans to take over control of exports of ASML's machines to the country. This is nothing new, guys. These export restrictions for semiconductors have been in place now for approximately 2 years. They're trying to restrict the amount of technology exported to China just due to supposedly national security risks, right? They're really trying to curb China's advancements in AI more than anything. The company's CFO said he expects to show a more normalized percentage in our order book and also in our business, talking about the China portion of the business. We do see China trending towards more historically normal percentages in our business. So we expect China to come in at around 20% of total revenue for next year, which would also be in line with representation in our backlog. In the June quarter, the recent one, the company said that 49% of its sales come from China. So you can see drastic decline in the exports to China, which is possibly hurting the order logbook and the revenue guidance as well, right? And that's not because demand from China is weak, it's because of the export restrictions. Clearly disappointing, to say the least. The firm's weaker than expected order book and a disappointing 2025 outlook were likely to overshadow decent Q3 results. We literally said that in the intro. The analysts added that ASML's lower guidance indicates that the delayed cyclical recovery and specific customer challenges are weighing heavily on 2025 expectations. Analysts at Cantor said the downbeat outlook for ASML was clearly disappointing and will weigh on semiconductor stocks. Obviously, it's already happened. However, they added that in no way, shape, or form does the company's updated outlook indicate any change in the AI growth story. And this is largely true, guys. A lot of the decline comes from the export restrictions to China. In terms of demand from other corporations like TSMC and other large manufacturers of semiconductors, they are still ordering through ASML right now because the demand is extremely hot, right? So a little bit of a mixed report, but as long as we understand where the reduction in guidance comes from, it's from China, the export restrictions, we can get a better sense of whether or not this is telling a story for the entire industry to slow down or whether it's company specific. And in this case, it is company specific. It's not necessarily it's saying that the entire semiconductor industry is slowing down. So that's a very, very important part that we cannot miss, right? Now, in terms of the valuation for ASML, at this renewed crushed share price right now, 730. Well, let's have a look right here, right? So I did two valuations for the company, and we'll get into why in a little bit, right? So in terms of the company's net margins for this business have always been good, about mid 25% range. You can see no change in net margins. If anything, gross is very good, operating margins is very good, and the bottom end here, net margins very consistent for the company, and this quarter was no different. So no worries about profits there at all. Now, in terms of EPS growth, we can see a very nice EPS growth curve, but 2024 is a slight decline from 2023, which is why I give two different numbers in my valuation, as we'll see coming up, because now we have a decline and then we have an increase, right? So I'll give two different ones, then we're going to blend them together. Revenue looks very good for the next 3-4 years. So definitely not a problem with the overall demand in semiconductors for the next 3-4 years, as we well know. Just a little bit of a blip because of that those China export controls, right? So revenue growth, very healthy 12% per year. EPS growth, very healthy 20% per year. I revised these numbers down by a few percentage points just because of that renewed guidance for 2025. So now for EPS, for the PE and PEG ratio at 2024 ending, considering the drop from 2023 to 2024 in EPS, we have a forward P for 2024 at 730 of 35.4. Decent. When we look at the PEG ratio, we divide this by the EPS growth rate. We get a 1.77. Anything under 1 is great. Between 1 and 2 is okay. Above 2 is very high. Now, if we take the 2025 EPS forecast, which you'll see is a return to normal growth for the company, well, then we get a better number, right? So the forward P at that point at 730 is only a 22.8, and the PEG at 730 is about a 1.14. So what we can do is kind of blend them together, right? We can take kind of like an average between the two. So 1.14 plus 177. The PEGs divided by 2. It's a very rudimentary way of doing this, right? But it gives us a good idea. This number, the number's never going to be, we're never going to be so off by doing this. The PEG's never going to be over 2 or under 1, right? It's going to be plus or minus, 5-10% margin of error, but at least it gives us a good idea. 1.5 is the blended. So fair valuation for the company, in my humble opinion. As per the technicals, guys, the next area that I'm willing to pick up some ASML, this full disclaimer, this one is in my long-term portfolio. I would really like to get it under 700. If we can come back down here, tap the 780, the 200 weekly moving averages down there. We've now blasted through this area of support. The next one is coming up, 680 down to about 600. If we can revisit that, guys, I will be adding to my long-term shares. In terms of a swing trade right now, I'd just be very careful. I'd wait for this kind of to level off a little bit, right? Maybe it furthers the decline over the next few days. Maybe we can get some daily oversold, and I'd love to find this one daily oversold. But for the short-term price action, guys, it's always more cautious and prudent to let these big earnings moves kind of level out here and find a local bottom so we have better levels to base our short-term trades off of. As of right now, it is still kind of catching a fallen knife, even though the hourly is crushed, even though the short-term, the 15, the 30, they're all crushed. I'd like to see a little bit more normalization and find a local bottom in this area. So those are my thoughts on ASML, guys. Decent quarter, but the guidance is really what clipped them back. And we know that guidance is not necessarily from a slowdown in the overall semiconductor business and the overall semiconductor industry as a whole, right? We know that it's more company specific due to some export restrictions. So those are my thoughts on ASML. Now, moving into company number 2, guys, this is going to be another big one. This is going to be UNH. So let's take a look at UNH right here. UNH coming in today, minus 8%. Another one of these earnings, guys. Very, very solid company, down about 8%. Once again, due to guidance. They had a very good quarter this last quarter, beat on the bottom line EPS 2%. And they did beat on revenue by almost 2% as well. But everything is about the guidance. So United Health forecasts 2025 profit below the street estimates and the shares fall. So let's get into it. United Health provided a 2025 profit forecast below the estimates as it expects pressure across its government-supported health insurance businesses. The largest US health insurer forecast a profit of as much as $30 per share. That upper end was below analyst estimates of 31.18. So a little bit of a reduction in guidance for profit here. That is a reduction of about a 4% miss. So normal that the share price will drop at least 4% possibly on this news. Any additional is just speculation at this point. United Health set next year's forecast more conservatively than is typical, due in part to payment cuts from the government for Medicare plans and low state payment rates across Medicaid plans for low-income people. The company said it would provide a more detailed forecast in December, and I will be looking for that one in December, right? So let's read a little bit more, then I'll explain in very simple terms, okay? Demand for healthcare services under the government's Medicare plans for people age 65 and older, or those with disabilities, has surged since late last year, as many older adults opted for procedures they had delayed during the COVID pandemic. Completely logical. The company, along with other health insurers, have faced elevated medical costs as a turnover in people enrolled in Medicaid left insurers with more sick patients. Although United Health historically guides conservatively initially, we believe today's guidance is reflective of the uncertain industry and cost trend backdrop. So I'll explain what's happening here, right? So this is a health insurance company, right? So obviously they charge a fixed amount of health insurance per year, and that is going to be your yearly fee, right? If you get health insurance, usually you have an increase every single annual renewal cycle, right? So here's the problem, right? When you have locked in at the early portion of the year, your healthcare premiums, the companies lock them in, but medical costs rise and rise and rise. It means that for everybody that's claiming for procedures, surgeries, other illnesses and whatnot, it means that the premium is kind of fixed up here, right? Or slightly increasing. If the medical costs are rising faster, it's squeezing the company's margins, right? And as well, this company relies heavily on getting payments from the government, right? In terms of these federal plans, Medicare and Medicaid, it helps supplement the amount of income that they get, not only from patients, but the government subsidizes the whole industry as well for these corporations, right? So higher rising medical costs, right? While insurance premium are not rising in line with the medical costs, and getting slightly squeezed by lower government payouts, it's squeezing the company's margins. This is what's happening here, okay? So United Health's third quarter medical costs exceeded Wall Street estimates as the company paid out more due to persistently high demand for healthcare services while receiving lower reimbursements on government-backed plans. That's literally what I just explained, right? So that is the gist of what's happening with UNH right now. Let's get into some of the valuation metrics. So United Healthcare really needs no introduction. It is the leader in healthcare in the USA at least, right? Extremely solid balance sheet, and they have a decent amount of margins, guys. Even though their margins are getting squeezed on their premium payouts, I'll just bring up the chart right here so you guys can see. Net margins for the company largely unaffected. I mean, the next quarter, they'll be a little bit lower as the company guided, but you can see net income margins usually always around the 6% mark, and it hasn't really changed over the past year. As a matter of fact, if we go on an annual basis, look, it's usually always around 6%. And this is true for the last 5 years. In terms of their premium payouts, we can see right here, right? Here's your policy premium earned, and then is your claims to the right? So as you can see, if we take the most recent quarter, 76.9 divided by 56.15, which is your policy claims, they collect about 37% more in premium than they have to pay out. So they do still have a decent margin of safety right there, right? So I've written down the headwinds. This is the same headwinds that they were facing last quarter as well. And I'll leave them here because they have not changed, right? Medicare, Medicaid spending, well, kickbacks from the government, right? This has been point number one. And the rising cost of medical services, we just went over it again, right? So still the same headwinds. But guys, this company is so extremely solid. I would not be too concerned about the longevity of the company. It always goes through these types of cyclical rising, lowering costs of medical services and government payouts, and then they lobby for more support, and then they get it. And you guys know how this works, right? Healthcare is heavily lobbied for by these companies. Now, revenue growth through 2027, 7.1% per year. Healthy EPS growth, 16% per year. No problem with the company's growth, guys. All the analyst estimates are consistently above the current share price, beautiful EPS expansion, and beautiful revenue expansion curve as well. I would not feel bad investing in this company at all, even after today's earnings. So at 556, where do we stand? We stand at about a 20.1 price to earnings ratio. If we put it on a PEG ratio, we get a 1.26 PEG. This is very attractive for an extremely solid company, guys. Couple that with the fact that we're doing one of my favorite patterns on the longer term timeframes. This is a monthly uptrend breakout of a 2-year range of resistance. We are now coming back and retesting it. I love taking this stock right here. As a matter of fact, I did open a little bit of a swing trade at the low of earnings. So anything in my opinion, guys, 550 down to about 530, decent little swing trade opportunity to be picking up this stock. And if you have it as a long-term investment already, well, for me, this one is kind of a little bit of an add to the portfolio, but it's just a long-term hold maintained at this point, guys. I really don't see any risks to United Health's dominance of the US market at all. For all intents and purposes, they are the industry leader. They will remain the industry leader for the foreseeable and probably medium and long-term futures as well. Extremely solid company, extremely solid balance sheet as well. And the fundamentals right now are looking quite attractive. So decent showing on UNH. I add a little bit up here, but of course, not financial advice for you guys. So that's everything with United Health. And as we can see here, they are a buyback king, guys. This is how they get such high EPS. Look at the shares outstanding count, right? Just buybacks on buybacks on buybacks, which is what I like to see for any company, right? So now let's move into company number 3, and we're going to tackle Bank of America. So Bank of America are another one of the very, very, very large banks to be reporting today, and they actually had a decent showing today, Bank of America. They were up a lot more, and then the markets kind of unraveled. But at one point on the morning, because of their earnings, they were up 3.4% before ending the day at about 0.55. But just to show you, the market did respond very, very well to their earnings before the ASML thing happened, and then all the markets rolled over, right? So a very nice beat on bottom line earnings right here, 6.4%, and a very nice beat on revenue as well, 0.36%. We're never expecting tremendous beats on revenues from the banks. What we want to see is that they just stay consistently growing, right? So let's get into their earnings, and then we'll go through the two things that we're most concerned about for the banks, guys. We don't really care about their profits that they're making in their trading divisions, their investment banking divisions, and the other fees that they're collecting, right? What do we care about? Number one is net interest income, the largest measure for the banks. Is it now curling up as rates are coming down, or is it getting worse? And number two, how do they feel about the consumer, and are they well capitalized? Do they have enough money on the side? If ever things hit the fan, we go into a recession, there's some deposit flight from consumers, people start defaulting on their loans. Are they well enough capitalized, and what is their outlook on the consumer? These are the main takeaways from the banks, right? So let's get into it. Bank of America tops estimates on better than expected trading revenue. That's fine, but that's not what we really want to, that's not what you and I want to know from these banks, right? We want to know about the health of the consumer because we have recession concerns. Revenue rose less than 1%. As gains in trading revenue, asset management, and investment banking fees offset a decline in net interest income. Completely normal. Last quarter, there were no rate cuts, right? So what we want to see is an inflection point in net interest income. If you don't remember what I was talking about last Friday and yesterday, or last Friday rather, when we covered these bank earnings to begin with, net interest income, guys, it's all about the demand, the supply and demand for, well, rather the demand for loans, right? I'll explain very simply. A bank makes all of its, or most of its money from loans, right? So one thing you need to understand is when the Federal Reserve interest rate is 5%, the banks will borrow at 5%, and then they'll lend to you at 6.5%, 7%. So they always have about a 1% to 2% spread, depending on your credit rating and stuff like that, right? But just call it a 1% to 2% spread that they make on every single loan. If rates go down, and now the Federal Reserve interest rate is 2%, well, the bank's going to borrow at 2% and still lend to you at 3.5%, 4%. They're always making the same spread, regardless of what the interest rate is, guys. But when interest rates are very, very high, the demand for loans is low. Nobody wants to pay 5, 6, 7, 8% to finance a house or a car or whatnot. So the demand for loans goes down. But when rates are super low, right, there's a high demand for loans. The banks pumps out more of them, and they always make the same spread. So that's when they make the most money, when interest rates are low. So we expect net interest income to be at a cyclical bottom right now, to round the curve. So this is what we want to know. Now, The quarter showed that the bank also benefits from surging activity on Wall Street through its trading and advisory operations, just as rivals JP Morgan and Goldman Sachs said. Wells Fargo said the same thing too. Fixed income trading rose 8%, equities trading jumped 18%, and investment banking fees surged 18%. So the whole trading investment banking division is doing fine. It's nice to see that Bank of America is a very large and well-diversified bank. While net interest income fell 2.9% from a year earlier, that edged out the Wall Street estimate. The NII figure, net interest income, in the third quarter was higher than in the second quarter. So we're doing this, guys, rounding the curve, a sign that the trajectory for this key metric is improving. The lender said in July that a rebound in net interest income was coming in the second half of the year. Apparently, they're on point. Bank of America seems to be turning the corner on NII inflection. So we have the information on NII. It's going in the right direction, so that's good. All the major banks have said this so far, by the way. Now, for the health of the consumer, well, let's take it from the earnings call from the CEO directly. Bank of America continued to demonstrate strength this quarter in an economy that continued to be stable, albeit with slower growth and falling inflation. So many of you asked me from time to time, what do we see in our own consumer customer base? As we talked about many times, our consumer payments is an indicator of activity. So let's have a look. Those payments were up 4.4 to 5% year over year for the quarter in the total money those customers moved in the economy. The pace of year-to-year money movement has been steady since late summer this year, after having fallen in the spring and early summer. This growth in consumer payments continues into October. This activity is consistent with how customers are spending money in the 2016 to 2019 timeframe, when the economy was growing and inflation was under control. So, not so bad, is it? This report is not meant to gainsay that consumers are worried of the cost of living, worried about higher rates, and other matters, but overall activity is fine. Unemployment is low and wage growth is steady, which will both bode well for the consumer overall and for consumer asset quality. This is a bank, guys, $338 billion bank. If you don't believe the data that comes out of the Federal Reserve, if you don't believe the CPI reports, if you don't believe any of the jobs report whatsoever, take it from the banks who have millions, tens of millions, hundreds of millions of customers between them, JP Morgan and Wells Fargo, and they all said the same thing. They have the data. They know how much people's paychecks are increasing by the data that comes in, right? So, moving on in. On asset quality, a few quarters ago, we told you that consumer credit losses would go down this quarter, given delinquency trends that we've seen at the time. We also told you that office losses would be lower, talking about that consumer real estate. Both of these proved true again this quarter. Good asset quality resulted in net charge-off in provision expense for this quarter at $1.5 billion, which is unchanged from last quarter. They are not setting aside any more money for credit losses because the consumer is healthy and they're not noting an increase in the default rate. Now, as with regard to reserve levels, is the company increasing its capital reserves because it possibly sees a recession on the horizon for outstanding loans and stuff like that? We remain reserved for an unemployment rate of 5% by the end of 2025 compared to the most recent 4.1% rate reported. They are doing a good job, guys. They are so well capitalized. They're well capitalized up to an unemployment rate of 5%. And believe me, if they start seeing an uptick, they will raise those reserves. So we are nowhere close to a 2008 cycle right now, guys. The banks are extremely well capitalized. I've been saying it for the past 6 months. No problems at all. And take it right here. Asset quality. This is the only slide we're going to go over. Asset quality, consumer and commercial portfolios. Consumer net charge-offs, right? So how much debt is the consumer just refusing to pay right now? And as you can see, it is now peaking and we're starting to see a slight little downtrend. It is not accelerating to the upside, guys. If you would see a crazy acceleration, it means that people are overburdened with credit. Their salaries have not kept up with their lifestyle expenses. And you would see this chart absolutely ballooning. I've now showed you 3 charts from 3 different banks, JP Morgan, Wells Fargo, and now Bank of America. They have hundreds of millions of clients amongst them, right? So take it from them. Healthy levels of debt for the consumer currently. And commercial, you might be worried about the office space, the commercial space. Everybody's talking about the office space going to blow up. Well, not quite, right? We saw the increase this year, which everybody was talking about, but it hasn't been getting exponentially worse. And now we are coming into a lowering of the rate environment. So this number should not skyrocket even more, right? We got through the roughest period for commercial net charge-offs, and now we're in a rate declining cycle. So if anything, this number should be maintaining slightly flat, maybe a little bit more, but we're not expecting the balloon. And that's what we want to see, guys. Consumer side is debt ballooning. Commercial side are people defaulting by the tens of thousands, right? We do not see that in these bank earnings just yet, guys. So keep that in mind, right? Now, in terms of the valuation for Bank of America, well, we can see right here, consumer stable, banks well capitalized, and no major increases in credit loss provisions. Revenue growth per year, 5.1%, very healthy. EPS growth per year, 10.5%. Bank of America does a great job, guys. They have very decent net margins, 15% net margins, nothing to see there. In terms of their revenue and EPS, gorgeous EPS expansion curve, gorgeous revenue expansion curve, although it's a bank, right? We're not expecting them to grow revenue by, 20% per year like a tech company, right? Now, forward P at $42, a 13.2, which is somewhat in line with the rest of the industry. Banks usually trade between 11 to 15. So this is roughly in line, and a PEG ratio of 1.26. So not that expensive, not too cheap either. You really don't expect to see banks over a 2 PEG anyways. So this one is fairly good. In terms of the technicals, guys, where I would like to pick up this company myself is in the event we retest possibly the lower $39 to $38 range. I would love playing some short puts down here. I'm not looking to own Bank of America in the long term. I'm not saying it's not a good investment. It's probably a very decent investment over the long term, which is why Warren Buffett holds so much of it, right? Even though he's been trimming. That being said, probably some decent upside in this bank over the long term, but keep in mind, the banks are usually a long-term investment, right? They move slowly, they pay nice dividends, you reinvest the dividends. But if I had to swing trade this one, be waiting maybe for a little bit of a dip in the event the markets just roll over for some reason in October, early November. If I can re-get the 39, 38, 37, could be a nice area to start writing some short puts on or building a little bit more in terms of a swing trade position. We do have a very nice monthly uptrend right now, so any further consolidation back into this area could be a nice opportunity for a swing trade. And that's how I see Bank of America right now. So that's everything, guys, for our earnings reports. Hopefully you enjoyed that. Now let's dive into our technical analysis, and give me a brief second. Thank you for your patience. So let's move into it right away. So we were expecting this pullback, right? We didn't exactly know what the catalyst for a pullback would be, but we were saying yesterday, when you notice the loss of the hourly trend, you can see it best on the futures chart, right? When you notice the loss of the hourly uptrend coupled with a loss of the 12 EMA, then you know most likely, right, especially on the SPY, you know that most likely you are in for a little bit of daily consolidation. That's exactly what we're having right here. After 5-6 days of nice rally, daily consolidation is underway. The bulls still control the daily uptrend right now. Let me just move this over. That's annoying. So the bulls control the daily uptrend right now. And as of right now, we're just looking for a daily higher low. At this point, anything above 565, looking for the daily higher low for possible further trend continuation. Catalysts for the rest of this week, guys, remain the big retail sales numbers that are coming in on Thursday. If they're worse than expected, expect the market to take a hit, because this is the most closely tied to the consumer, if anything. And of course, on Thursday, another big day on Thursday, right? TSMC and Netflix. So Thursday is going to be our biggest day, guys. Retail sales and TSMC and Netflix, those will be the largest market moving events. Now, tomorrow we got ASML out of the way, so we don't really have much. We have Morgan Stanley for sure, but not really anything major tomorrow to speak of, right? Kind of like second or third tier companies for tomorrow, so not that big of an impact. And even on the macro, there's literally nothing tomorrow at all, right? So that being said, just looking for a daily higher low for possible further trend continuation. And even if we give it all up, guys, take this all back, set up the daily downtrend. You guys know the drill. Been talking about this for 2-3 weeks at this point, looking for a weekly higher low for possible further trend continuation. The weekly level to look for is going to be 565 down to 560, but we'll tackle that if we lose the daily when we come to it now. And then moving on to QQQ, also QQQ, daily pullback underway, right? You guys know the drill. If you lose the hourly time frame and you lose the 12 EMA, you know that you're probably in for a little bit of daily consolidation. That being said, there is a lot of space. Anything above 478, looking for a daily higher low for possible further trend continuation. And the bulls have a decent amount of space, right? And this area is support 482 down to about 480. Now, in the event, guys, we roll this one over, TSMC and Netflix absolutely destroy us, and we go into weekly consolidation. You guys know the drill. The bulls have a lot of space. Anything at this point above 448, just looking for a weekly higher low for possible further trend continuation. So we will tackle that if we come to it. But as of now, no major red flags, just one day of pullback. We'll take it as we do on the channel, one day at a time. Moving into financials, still up on the day despite retracing a lot of the gains. Now, financials looking extremely good, guys. Nothing to see on this chart, right? Daily uptrend is clear as day right now. Any pullback looking for a daily higher low for possible further trend continuation. And if I had one level to point out to you guys, it's probably going to be the retest of this wide range, right? This is pretty much a 1 month range on XLF, and that is going to be the classic breakout, possible retest, and maybe rally. And in the event, guys, we give everything back up, daily downtrend, you guys know the drill. Who's in control here on the longer term time frames? It is definitely the bulls, right? So weekly higher lows are set. Any move lower, looking for a higher low, anything above 44.64, weekly higher low for further trend continuation, which is why I say look for the breakout retest trade of the previous highs right here. Could be an interesting area for a little bit of a swing trade. Now that we know that financials are going to be pretty good, guys, when rates keep coming down, right? That net interest income is bottoming out. It should be getting better as demand for loans gets better as rates come down, but it's a very long process, right? Moving into XLV down 1.22, largely due to the UNH drop, of course. So we know that we were in a daily downtrend. We got a nice engulfing move on the last leg of selling right here. And now the bulls need to play some defense, need to set up the daily higher low and go for the daily trend change, right? If we give it all back, the bears have a chance at just continuing this weekly downtrending cycle, because as of right now on the weekly, we're always looking for a lower high. And then it's up to the bulls right now to put in the stop, get the daily downtrend right here, and start making some moves on the weekly, right? So we need to confirm the daily uptrend first. That is step number one. So we'll keep a very close eye on it. Would not like to see us come back down to the support level. You would lose all of your momentum, guys. So keep a watch on this, but support is definitely 151 down to about 149. And as I said on the weekly, we are trying to get some space here on the weekly, but until we get that daily uptrend shift, we cannot say that the weekly lows are absolutely set in stone, right? You could just be looking for a lower high into lower low if they roll over this daily. So setting up the daily uptrend is absolutely crucial at this point. Longer duration timeframes though, the monthly, who's in control here, guys? You tell me. The bulls, right? At the best area, even if we lose this and roll over the weekly a little bit more, you guys know this yellow line, right? Monthly time frame, back test of 147, beautiful area, monthly higher low for possible further trend continuation, confluence with the monthly 12 EMA as well. Now moving into semiconductors, the loss leader of the day, 5.4% to the downside, big move down, and they really blasted through our area of support that we just reclaimed. So unfortunately, this one is now going to become resistance again, but at least the bulls had a lot of space, right? Daily uptrend was clear as day. And now we're looking to protect this higher low right here, 237. So going to be looking out for the daily higher low for possible further trend continuation, but the bulls need to play defense as of tomorrow, guys, because one day this was a big move down, right? 61.8%. So if anything, this kind of does favor the bears for lower high into lower low rollover. That will highly be dependent on what comes out of TSMC on Thursday morning. So pay special attention to that. If we give everything back, guys, we're looking at big support down here, 238 down to 225. Should be familiar. We were just there. And if we give it all back and roll over the daily downtrend, you guys know the drill. Looking for the weekly higher low for possible further trend continuation. The weekly higher lows look into this zone, as we just said, right? 238 down to 225. Anything above 213, looking for the higher low for further trend continuation. So keep our eyes peeled. Semiconductors will be very volatile. And I've told you guys how I like to play these semiconductors, right? By writing short puts significantly under the market so we can get great levels for entry in the event they come down into us. Moving into IWM Russell. Russell getting rejected once again at the 226 mark. No secret there, guys. It's been a very challenging area for the bulls, and that is because we are pulling up into this whole area, guys. 225 up to about roughly 235, right? Very solid resistance for the bears. So that being said, we're still currently looking, guys, for the daily uptrend continuation, looking for the daily higher low for a possible second attempt at this rally. Now, in terms of the weekly not looking the worst. I'll give them that. It's a nice tightening range. Looks like a bull flag setup in my humble opinion too. So we'll be watching, and this is going to be highly dependent on the direction of the SPY and the QQQs, right? If the SPY and QQQs continue pulling down, do you guys think the Russell is going to smash through this? Probably not. We may just go into the furtherance of this tightening range a little bit more. I've said it once, I'll say it again on the channel, guys. I'm really only interested in the Russell if we can retest the 210 and a 208. I think up here, it's kind of too close to go for the breakout trade. It's too close to this area of resistance, right? I need better risk to reward for this trade. And lastly, moving into the Dow Jones pulling back hard, 0.75%. They were doing well this morning, guys, but then, well, they actually doing fairly well until we got the big drop at the open right here. So that being said, because of UNH for the most part, right? So moving on in. So let's take a look right here. Daily is looking great, guys. Daily is still in control of the bulls right now. Daily higher lows are set all the way down here, 41,900-ish. Just looking for a daily higher low for possible further trend continuation. So keep an eye on the back test of this location. Prior resistance for about 2 weeks should be current support. We have the 12 EMA acting there as confluence as well. And in the event the markets roll everything over and we get the entire engulfing move, lower high into lower low, we'll just understand who's in control here. The weekly bulls are at massive control, just still looking for a weekly higher low. Anything above 39,971, just looking for that higher low for further trend continuation. So not looking too bad, all things considered, guys. Even the Dow Jones, 1 day of pullback. We will see how it shapes up in the future. Moving on to yields, going to cover yields very, very briefly here. So yields getting rejected from the area that I labeled yesterday, right? We knew overbought conditions, right? Significant rally over the past 3 weeks, roughly. We knew that eventually we were going to be due for a pullback. So nice to see that's finally manifesting. And TLT as well, right? Reacting almost from the zone of support. They're never equal moves, right? So I'll give you guys an idea, right? We had a 1.85 move down in the 20-year, and the 20-year bonds today only moved up 1.22. So they're not perfectly inversely correlated, right? 1% down on 20-year does not mean 1% up on the TLT. They don't move perfectly in line, but very, very, very close, which is why I like using the 20-year yields as my guide for TLT, if that makes sense, okay? This is the guide. TLT is not the guide. The yields are the guide, right? So getting rejected, we will see if the bears can pull back enough of this move, set up for the lower high into lower low, and just possibly for, setting up for the weekly highs. And then we need to reverse this, right? Because we know we had the weekly downtrend. Now they put in an engulfing move. The bulls, on the yields at least, want to see this happen. But we know what's in effect here. The longer term timeframes are at play. It is currently a monthly downtrend. So if anything, we're only looking for a monthly lower high into probably monthly higher lows as well. So I would take this weekly move with a grain of salt, which is why I still say that I think TLT, guys, is very, very close to having bottomed out in the short term. Take with that what you will, not investment advice, of course. Now, moving in further, guys, let's move down to our big tech names, shall we? So moving into Apple, putting in, I cannot believe it, guys, even with the struggles today, Apple put in a brand new all-time high by a few pennies, by about 20 cents or something like that, but they did it. They broke the all-time highs, looking good for Apple, guys. And as we were saying, waiting for this trend to break out, and they just broke out of the trend. So daily uptrend is set right now, looking fairly good. Any pullback at this point, looking obviously for a daily higher low, anything above 221.58, daily higher low for possible further trend continuation, right? We know this area, this higher area right here, has been very, very challenging for Apple to break through. Look at all the times they got stuck, they tried to break it, got stuck, they tried to break it, didn't do it, right? Got stuck here a while. So this whole area, 232 down to about 228, I'd be maybe looking for Apple to back test this location. The moving averages are there as well. Maybe higher low setup into daily uptrend continuation. The weekly is looking good too. If we close the weekly like this, guys, we finally have a confirmed weekly uptrend on Apple after triple topping this on the weekly, looking quite good for some continuation. But the risk reward here, guys, is just not worth it in my opinion. I will really stay on that. What I would like to see for Apple really is either a breakdown and open up some short puts down here. But if we're trying to play the upside, I need to see a more reliable break than this, right? I need to see a break of the all-time highs. Give me like 3-4 days of rally, then pull down for the retest, and then I might get interested. This right here, although it is a break, guys, they can so easily snap it back. So I need to see more wiggle room for a trade setup like this on Apple, right? Even though it's not my preferred trade setup, it is a trend continuation setup. For the long-term investment, too pricey for me, Apple at the current time. The PEG ratio is, well, now it's about 10% higher, right? So the PEG's probably like 3.3 right now, which is kind of crazy. I don't really want to take positions on Apple until I see their earnings at the end of the month. So I kind of keep this one on the back burner. Haven't played it in a while, but when we do play it, you guys know that I like playing it heavy. I just need to have my ideal conditions met for this one. Moving on into AMD. AMD also not looking the worst, all things considered, right? I mean, everything in semiconductors dropped 5, 6, 7% today. ASML down a lot, right? So AMD, unfortunately, unraveling here, collapsing the daily uptrend, right? So loss of the daily uptrend because we flushed the lows. So now at this point, guys, it is all about the weekly, right? We know that the expected possibility right now is maybe just lower high on a bounce and lower low. We're still kind of relying on this area of support. You know, I've talked about it a lot, 163 down to 154. Been a huge area of congestion for AMD in the past. So we're almost through it right now. And if we do get through it, guys, with some continuation to the downside tomorrow, well, possibly lower high into lower low, daily downtrend reconfirmed. And then at that point, it's all about the weekly, guys. The weekly bulls need to start playing defense in the 150, 145, because we're looking for the weekly higher low for possible further trend continuation, guys. Anything above 132 should be looking for a higher low. So at this point, we need to wait for the daily momentum to kind of even out here, give the bulls an engulfing move, get the daily uptrend back, and then we will know that the weekly higher lows are set right now. But my favorite way of playing this one, guys, when we get big days like this, is writing short puts well below the market. So if ever it comes down there, we know we're expecting possibly a weekly higher low. Maybe it fills us, assigns us, and then we get a little bit of a bounce, right? Makes sense? So moving on to Amazon now. So moving into Amazon, not looking all bad, not looking too bad, all things considered, right? At one point today, Amazon was down a decent amount from the open, but they did a good job of recapturing everything, which is why you can barely see this candle on the chart. It's like an invisible candle, right? If I remove, maybe you can see it right now, right? So invisible candle on Amazon. What are the bulls looking to do? Well, we know, right? We had the daily uptrend, we lost the daily uptrend, right? Daily downtrend, and now we have an engulfing move, got rejected at this little area of resistance. That's not so little. It's plagued Amazon quite a few times this year so far, right? So got rejected, but we know the bulls, what are they trying to do? They got the engulfing move, looking for the daily higher low for possible further trend continuation, and the daily MACD is looking quite decent for some continuation. So if the markets recover a little bit tomorrow, I think Amazon is one of your prime candidates for a little bit of a rally here. Amazon only has earnings in 2 weeks' time, so we'll monitor those very closely. So at that point in time, guys, just keep an eye. Can they get the break and the daily trend change? If they do, know that your weekly higher lows are set. And we're probably just looking for another weekly leg higher, possibly taking into the all-time highs, looking fairly good. And in the event Amazon rolls this entire move over, right, takes it all back, sets up for the daily downtrend change, and just goes in for a little bit more weekly consolidation, well, I will be sitting right here, guys. 180 to 178. I like this zone. I'll be sitting here with some short puts and maybe even some call options. I love, love, love Amazon, guys. And this is a very solid area for the stock as a whole. My preferred zone is down to 170, but we may only get there off a big earnings miss. And if we do, I will be going for leaps on Amazon with some decent size. Moving on to Google right now. Google not looking too bad, up about 0.33%, right? Trying to challenge again, once again, the 169. So we know the context of Google, right? They were in a very nice daily uptrend. And then unfortunately, we lost it. Daily downtrend, nice engulfing move right now. So it's up to the bulls to do step 2. Step 1 is complete, beautiful engulfing move. Now we need the daily higher lows and the higher highs for the daily uptrend shift. Only then will we know the weekly higher lows are set, possibly looking for that weekly trend change. Just be mindful, guys, 179 down to 171 is resistance above us. I still maintain if we come back down into the 160, I love playing the 160 short puts on Google, guys. I love playing the call debit spreads down here too. And in the event that, you know, we come down lower than this, even with earnings coming up in 2 short weeks time, if we come down lower, I'm going to be loading up once again on leaps, guys. Anything below 160 down to about 150 for leap call options, a year and a half worth of time. At 80 deltas, I think is very good value. So we'll monitor Google's price action closely, but just keep in mind, going for the inverse head and shoulders here. Moving on to Meta. Meta also not looking too bad in the grand scheme of the markets today, right? Down 0.7%, slightly undercutting the lows, but I'll give it to the bulls, right? Not a consistent slide and also not closing below. So daily uptrend is still maintained, but it's getting tight. If we lose this level right here, 581, let's call it, that will be daily downtrend underway. And at that point, you must expect some weekly consolidation, right? Beautiful weekly move up, looking for a weekly higher low for possible further trend continuation, excuse me. They also have earnings at the end of the month, so it's fairly still a while away, right? So you notice here on the daily, Daily MACD is curling over. So if we lose this and Meta goes into consolidation, just understand the weekly bulls are in full control here. And if we get a back test of 545, 540, this region right here, nice little breakout of the range of resistance, breakout, retest, and possibly run, I will be sitting here for a trade opportunity on Meta, looking quite good, right? No major red flags on this stock. Moving into Microsoft right now, 0.10% to the downside. And Microsoft not able to kind of keep it up, right? So we know what they were going for. They went for the daily uptrend shift into resistance, got rejected yesterday. That's 424 up to about 433. Challenging area for Microsoft all throughout the year. So no surprise we got rejected there yesterday. Now what the bulls need to do, guys, is they need to play defense. We have the daily uptrend right now. We know the daily MACD is looking good for some momentum shift to the bulls for further continuation. But if we lose 413, guys, you lose the daily uptrend, you set up the bears for the lower high into lower low, and unfortunately, you will just continue this weekly consolidation, coming right back down into 405, 400. This is the area, guys, that I'll be sitting with some bleep call options. I love Microsoft down here. And you may remember, every single time this year, Microsoft has come into these areas, we've always taken swing trades, and for the most part, all played out very, very well. So that's the area. I'm still playing Microsoft here with some call debit spreads, but not tremendous size. The big size comes in for me if we retest this location. I'll be going at it a lot heavier. The fundamentals are great. Now, moving on to Netflix. Netflix also sliding a little bit today, 0.98%, but I mean, how much more price action do we have before Netflix, guys? Only 2 days before their earnings on Thursday. So as I said in the last few weeks, I wouldn't be surprised if Netflix doesn't have crazy breakouts or crazy breakdowns. And they've been largely doing the same. We tried to go for the daily uptrend breakout, got pulled back because of recent market weakness, and just pulling back because of some earnings, right? Just earnings volatility coming into the mix right now. I still maintain we haven't lost any major levels. That would be a loss of 697. If you lose that, unfortunately, you lose the daily uptrend. You set up the bears for the lower high into lower low. But we won't have time for that price action before earnings, right? Earnings is going to move the stock 6-7%. If they move it 7% to the upside on a great beat, well, you know where we're going. We're going about 750 psychological resistance. And if they move it 7% to the downside, you know where we're going. Well, down all the way down there, we would probably blast through this area of support. Unfortunately, we had some decent cushion. Now the cushion is eroded, right? If we would have started from earnings in the 730s, we would have the cushion in the support. But now if we started from down here, not so much cushion anymore, right? It can even blast past our weekly higher lows. So we'll pay special attention to the reaction on earnings. One thing's for sure though, guys, if I can find this one after earnings, like 660, 650 even, I'll probably go shopping for a little bit of short-term swing trades on Netflix. But as of right now, no major things are lost, but we have to wait till earnings, guys. Predicting the short-term price action before earnings is really, really hard to do. Moving into NVIDIA right now, NVIDIA down about 4.69%. So we know what NVIDIA was going for, right? Daily uptrend, looking for the daily higher lows for possible further trend continuation. Coming into our first level of defense, 130 down to about 126. Prior level of resistance should now be support for the bulls. 12 EMAs there as well. But even if we give back more, guys, there's a lot of space, right? Anything above 115. Just looking for that daily higher low for further trend continuation. We'll take this one day at a time. If they take back way too much of the move, you may be expecting lower high into maybe lower low. And at that point, we'll just be looking for a weekly higher low for possible further trend continuation. The larger weekly level is down here, 420 to about 415. So we'll take this one day at a time. But as of now, guys, no major red flags, right? The bulls are starting to play defense down here. So we'll see how they continuously react to this zone over the next few days. Moving on to Tesla. Tesla's still doing absolutely nothing after its robotaxi event, unfortunately for them. Daily downtrend is still in motion right now, bottoming out towards the 200 daily moving average, and we're reacting nicely from the overall 220 to 200 area of support, right? We know it's been a very highly challenged. Sometimes it blasts through, of course, right? But so when we're at the 200 to 220, it does usually act, if we're over it, as support. And when we're under it, it does act as resistance as well, right? So very, very big area for Tesla. A lot of moving averages in here as well. The weekly, unfortunately, guys, has lost all of the momentum. So the big catalyst for Tesla is going to be their earnings coming up in roughly, actually, you know what I mean? Next week. I said 2 weeks time for all these companies, but every one of them is next week, right? I guess 2 weeks if you include all the rest of this week. So most of big tech next week. So we'll see not that much in terms of price action prior to earnings on Tesla, right? Just watch how deep we cut into this zone because Tesla on earnings moves about 10%. If you cut too deep into this zone, guys, There's no more cushion, right? Now we have a 10% cushion between here and the low of that range. But if you start cutting with the rest of the market, if we start dropping here, you cut down here, and then Tesla goes down 10% off of earnings, we are going to revisit the 180, 175 location very, very fast. But as of now, that's just projections, right? That's just speculation. None of that has happened just yet. What you'd like to see the bulls do is mount a little bit of a recovery rally in the next few days. We're no longer truly hourly oversold yet. 4 hour, barely, right? So it's not as if we're crushed. It still can move a little bit lower, but you'd like to see the bulls recover a little bit more of this robo-taxi event drop to insulate themselves before next earnings, right? So Tesla, still a bit of a no trade for me before those earnings, just because of where we currently stand right at the big support level, right? Very challenging to position prior to earnings. And lastly, Palantir coming down 2.24%, completely normal move by Palantir, no major red flags. Who's in control here? Still our bulls. Beautiful daily uptrend, looking for the daily higher low. Anything above currently 39, looking for the daily higher low for further trend continuation. And if the bulls take back the bears take back too much of this move, if we get 100% engulfer, guys, you probably know what's going to happen. Maybe the lower high into lower low, loss of the daily uptrend, but that's not a bad thing. That would just be for a beautiful attempt at a weekly higher low. Look how much space we have, guys. Anything above 29, just looking for a weekly higher low for further trend continuation. So we'll monitor this move very closely. But as of now, the bulls control the daily, just looking for the daily higher low. You start to have a little bit of red flags on the daily. If you take back way too much of this move, it opens the door for the daily downtrend shift and just healthy weekly consolidation. Watch how it reacts at 38, 39 at that point in time. But all in all, Palantir not looking too bad at all today. And that's pretty much everything for our stock recap, guys. In today's trade, right? We had a couple big names to the upside. Charles Schwab, we'll cover them tomorrow. We had a lot more earnings. Tomorrow, we'll cover Charles Schwab. We'll probably cover either Johnson & Johnson or Progressive, whichever one looks more interesting to me. And we'll also cover Louis Vuitton, which also had their earnings today. That's not on that list, but they were down about 8%, once again off of concerns out of China. So there's a lot of things that moved today. Some solar plays had a big move today. The rest is largely earnings. China trade still a little bit weak as investors are not satisfied with the level of stimulus just yet. To the upside, really mixed, right? Not tremendous outperformance of any names in my list to the upside. So we'll cover a little bit more of those over the rest of the week for sure. Now let's get into some of the trades that we took for the week, right? So there's some here that will not be showing because we already closed them. So I'll go through a few of the wheel trades that we took today. So Elf Beauty was a great wheel trade that we took early on in the morning. I'm happy to say, guys, that we pretty much sniped the bottom of the Elf. Well, that's not the bottom. The bottom was down here. Pretty much sniped. For all intents and purposes, we really got some of the lows of the day right here. I think it was right here where we positioned for the trade. I forget the exact timestamp, right? You can probably see right here, 10:37 a.m. So we were towards the lows. We got almost the high of the day on these puts. 99 puts, a good margin of error for 43 cents, roughly the 0.5% rule. Not quite, but I respected our ROI on an annualized basis. We closed it after the pump. 43 to 20 cents, closed over 50% of the contract value realized. And what did I do with it? I reallocated it to NVIDIA, going for the 123 strike for 40 cents. So I'll explain a bit of the logic. ELF, right? We only had 20 cents left, 3 days to expiry, 24% left on the annualized basis for that contract. If we kept the ELFs and didn't close them, the new NVIDIAs giving us 39.6. So that's when you see me optimize this wheel strategy midway through the week. If I can find an equal opportunity with better premium, I will take it every single time. So those are a bit of the wheel trades that the one that you didn't see today that I already closed. A few of the other ones that we closed today, guys, we went back and we closed a few of the profitable trades from the past. So you might remember here, guys, we took the Google short put. This was a Google put we took last week at the 160 strike, a longer dated one for November's for $6.11. We closed those today for a very healthy $4.05. That is a 35% ROI on the contract, but in terms of ROI per day, you guys know my wheel criteria, right? You want 0.5% per week. So this one we got 1.3% in 4 days. That's why I like going for longer dated puts sometimes when the criteria is right, because we can pull the premium forward and get much better ROI per day, but you have to be very very good at managing these positions and entering them properly. I've talked about them a few times on the channel. We also closed the bull call debit spreads we had for Google. We opened these all the way back early September. We've been in them for a while, but we closed them, just de-risking a little bit before earnings. Not such a juicy trade, but still profit's profit, right? 16.5% ROI in just about a month. Not the best for call debit spreads, but a win's a win. I'll take it. And then we also closed the BITX. You may remember I did a longer dated wheel strategy again, going with the $24 strike for December. This is Bitcoin, 2 times leverage. We got $4.30 on the when we opened the contract. We closed them today for $3.10, as you can see down here. That is 5% ROI on the capital employed in 4 trading days. Well above the 0.5% week per week rule, guys. So these longer dated puts, if you're looking for them in ideal conditions, they can provide you some very juicy ROI from selling options, right? So that's pretty much everything we had in terms of the plays that I closed. And now Interactive Brokers does what it does best. It logs me out right before I get to my position. So let me just log myself back in on my phone, because if I take any, if I have to cut the video and log in and spend some time on the other screen right here, so you guys don't see my username and how long my password is, right? So if I don't do this live, I have to put it in an editing software, merge the 2 videos together, and it's just a lot longer, right? So please allow me just a few short seconds, instead of having to edit the video and adding like 30 minutes of processing time on these. So let me just pull it up real quick. Let's see if I can get it fast enough for you without spending too much time talking. So let's see. All right, let's go. All right, so we got them right there. So this you can't see. It's not displaying, unfortunately, it's not displaying the call debit spreads properly. Now it did. It just readjusted, right? So ASML, we went with some ASML call debit spreads on the drop. I did not get the low of the day. As you can see, we are already down. I'm willing to average into these. They're for January's, right? Above, they're about 5% above the share price when we bought them. I got the early part of the drop, but not part 2 of the drop on ASML. We will average into this position. I went very light, guys, only $400 of exposure. We're already down. I'm going to average into them. We have until January on these contracts. Moving on further, the other ones that we opened today, well, one of them is the Louis Vuitton shares. 128 was my average cost after the earnings drop. Let me just put this back into my thing right here. So after the earnings drop on Louis Vuitton, we were able to get some very decent fill after the earnings drop right here at about the $128 level. Now we're there right now, but you guys know me. I love this company. Long-term stock, we'll cover their earnings tomorrow, but now we're really getting into the juicy areas of last levels of support, right? 130 down to about 115. Very, very juicy pricing on this stock. So I added to my long-term portfolio, but I put the equal amount of shares in this portfolio for a little bit of a longer duration swing trade, just because I like the share price so much. And lastly, you'll see my NVIDIA contract right there, the updated wheel trade. And then lastly, we did another trade as well today, guys. We went with some UNH shares. Very light position on UNH. I have to admit myself, extremely light. You'll see only 5 shares, right? Because I'm willing to DCA through the 520. Remember, this is a larger range. I would love to say that I picked the absolute bottom today at 550. I did not. But if we continue consolidation, just know what time frame we're targeting here. Monthly higher low. So I will be looking to average into this one in the 520 range. If we clip down into there, I'll be looking to add a bit more, and I want to get the follow through, but this one may take a little bit more time to recover. So that's why I went a little bit lighter on the entry. Other than that, guys, you'll see, even though it looks like I have a lot of positions, there's not a lot of large exposure, right? Very few wheel trades. If anything, I have, 60, 70% of my buying power still waiting for those earnings plays, not getting too greedy, not spending everything. We are literally only in the first few days of a 3 to 4 week earnings cycle. You do not want to spend all your money in the first couple of days, even though we've been getting some good discounts, right? That's why not so many wheel trades. I'm being very diligent on closing profits early. When they hit my levels of resistance, I take the profits and I move on. Still cautiously optimistic in these markets, guys, but you have to be very diligent with your swing trades. If they hit your levels, don't get too greedy. Take the profits, move on to the next trade, and wait for the opportunities that this earnings season will bring. So hopefully that was helpful for all you guys. If it was, consider dropping a like on the video. Would really appreciate it for the growth of the channel. Second, if you're new to the channel, consider subscribing. Would love to have you here. We do these every Monday through Friday after the close. And lastly, if you have any questions at all, guys, if you want me to look at a specific stock, if you want me to look at a specific, give you a second opinion on an options play, if you want to discuss macroeconomic news, anything you want, leave it down below in the comments. And if you want access, guys, to all of my private trades, right? The ton of trades for everybody, weekly wheel trades, the longer dated wheel trades, like I showed you, right? Pulling premium forward, shares and call options, the long-term investments, all my ideas, the private live streams, the private videos as well, and chatting with me every single day, asking me opinions on trades and stuff like that, all throughout the day and night. Well, click the link down below and that'll take you to the Discord and give you more information about that service. So thank you very much, guys, for tuning in once again. I'll see you tomorrow after the close. Happy trading, take care, and peace.